So you're thinking about buying a home in San Diego, California, but today we're going to be talking about the top 10 do's and don'ts you got to know before you get into an accepted offer. And we're getting after it right now. What's up, amazing people? I am Liz Lepore here with the Mortgage List team located out of San Diego, California. And if this is the first time to my channel and you're looking to learn everything you got to know about what it's like to eat, live, sleep, and play here in San Diego, then this is a channel for you. You definitely want to click that subscribe button, tap that little bell so you're reminded every single time we release a new video. Because honestly, we do it every single week. And honestly, my team and I are receiving phone calls, text messages, and emails every single day with people just like you thinking about making that move to somewhere in San Diego or somewhere in California. And if you're thinking about making that move, you definitely want to give us a call. Send us a text or an email, whatever is easiest for you. Because honestly, we got your back when moving to our area. Now, let's get after the top 10 do's and don'ts you got to know before you get yourself into an accepted offer. So we're going to cover both the do's and the don'ts. So first off, you got to know that there's a lot of really relevant information you got to know before you get yourself an accepted offer. So as you're looking for San Diego homes right now in this market in 2021, you're going to end up finding that homes in general is a lot more of a scarcity aspect, meaning that there's a lot more buyers, there's a lot less sellers, and you got to be ready to go when you do find your accepted offer. When that day comes, you got to also make sure that you don't rock the boat. You don't create hiccups or open up Pandora's box and create more problems for your situation when you're in the middle of your escrow period, whether it's 17 days, 21 days, 30, 45, 60 days, whatever it may be. You got to know those do's and don'ts to make sure you avoid them and avoid the hiccups to make sure you have an easy and smooth process. So at the top of our list when it comes to what you do need to do is you need to notify your lender when your income changes. So let's say, for example, that your position was a sales manager and you had a straight salary. Now you're no longer going to be the sales manager, you're going to be a regular sales rep, meaning that now you're going to have a commission structure. Well, you go from a salary to now being commissioned. Those are two completely different incomes and they get calculated two completely different ways. And then depending on your situation, it could make or break your loan. So you want to make sure to advise your lender that your income is actually changing, whether it's changing from a position or changing the actual salary that you're getting. Or if it just means that you're changing your employment. All of it definitely irrelevant information. Next on our do's, you definitely want to let your lender know if your address changes. So why your address? Well, a lot of times things get mailed to you during those 30 to 45 day process. Your lender definitely wants to know that your address changes. One, for the fact that your stuff is going to get mailed to you. But for the other detail is if you're a first time home buyer or if you're renting right now and you move somewhere else, your new location of where you're actually going to be living at definitely needs to be referenced so that way they know how much rent you're paying for in that area or in that location, whether you're living with your family or you're totally just changed your brand new rent situation and now you're paying more rent than what you did before or you're paying less rent. All of that needs to be verified to make sure that your payments for your rent are on time. So if you change your address, you definitely want to let your lender know. On to our next do, and that's going to be that you do definitely want to get home insurance, which is fire insurance. So too many times we wait till the last minute to get that home insurance and fire insurance. Back in the day, home insurance used to require an appraisal. Nowadays, because of all the technology, you don't need an appraisal to be able to get an insurance quote. You definitely want to get your insurance ahead of schedule in the very beginning. Because just in case, let's say your home is going to be located in Ramona versus you living right now in Escondido. Well, that's going to be a really big difference because your home insurance for Ramona could be closer to like $3,000 to $4,000 because of the high fire zone. Whereas in comparison to like, let's say Escondido and San Marcos, you're going to be looking at home insurance for closer to that $1,200 to $1,500 range. A lot of that has definitely to do with the location of your new home. So definitely food for thought. Other thing that you got to remember is that when you're doing the qualification or you're being qualified by your lender, they definitely need to make that adjustment. So if you're buying a home in Ramona and they're estimating your fire insurance at $1,000 a year, you know, and I know, as we just talked about, that's not going to happen. odds of you having fire insurance in Ramona for $1,000 to $1,200 is not likely. So you definitely want to anticipate the estimate and your debt and your qualification, all for the total amount of what you're expecting in the area. Ramona, above $3,000 to $4,000 when it comes to your fire insurance. Next on our do's is that you do definitely want to keep a paper trail. Okay, so what is a paper trail? Okay, so think about you depositing money inside of your bank account. Well, you deposited $1,000. One would think, who cares? It's money, right? That's not the case. A lender is going to make sure that they gotta know where that money came from. Whether it's money that you deposited because it was a gift from your mom, if it's a cash deposit, there's no paper trail. So you gotta be able to have a paper trail. And before you actually deposit any money inside of your account, you definitely gotta talk to your lender to make sure that what you're depositing is actually gonna get used. Well, now you can actually verify that paper trail. You can verify the check stub, you can verify the back, that it actually came from her account, and that's how you got it. When it comes to the cash, you can't verify cash that's sitting underneath your mattress. So all of that stuff is food for thought. You got to make sure that you're able to verify the paper trail. So you definitely want to hold on to all that documentation. Don't throw it in the trash when it comes to the paper trail as to where and how you got those deposits that came into your bank account. Next do is that you definitely want to let your lender know if you have been moving money around. I had a client that was moving money all the time. Our escrow period was only 30 days, and he was constantly moving money from one account over to his stock account just so he could work the market. Typically, it's not a big deal if you were not in an escrow period. Think about how many moving times that you moved $5,000 into that stock account. Now you have to be able to paper trail it. You need to be able to show that that same money that came out of your bank account is the same money that went into that stock account. And if you can't paper trail it, then that money is no longer usable. It'll be as if you technically spent the money. So you want to make sure that you keep all the paper trail, that you're transferring money from one to the other if you transfer it. And when you transfer the money, that you also supply that documentation back to your lender so that way they can clearly see where the money is now. Now that we covered the top 5 do's, let's cover the don'ts, okay? So today we're gonna have 5 don'ts that we definitely gotta know before you get in your offer acceptance. So at the top of our list is that you do not want to run your credit and get new debt. So that includes a car loan, personal loan, student loan, credit card, that sort of stuff. You add new debt that was not on there when you first got pre-approved or when you first got approved. Now you're changing your qualification. So if you were on the borderline and you were spending that 45% of your income, and if you've watched any of my other videos, I talk about how much you're allowed to spend on a typical loan. Based on those 45%, based off $1,000 of income, 45% of the $1,000 is $450 out of the $1,000. Let's say that you were at the maximum and you were already spending 45%, and then you decided to go buy a car for $600 a month. Well, that $600 payment is most likely going to make or break your loan. That $600 payment is most likely going to break your loan if you were already on the border. Keep in mind that in general, you don't want to be changing any new debt. You don't want to be racking up your credit card either. And you definitely do not want to be added to any authorized signers for somebody else to be able to make new credit. By that point, you've already made your credit, you already got your credit score. No new lines, no new debt are required. And you got to make sure that this one is definitely one that you don't do because you'll run into major issues during your 30 days. So this tip also has to do with all the way to the last day. So meaning that you're going through your 30-day process or 15 or 17-day process or 21-day process, and you're about to close on your new home. So until the day that somebody tells you the loan is recorded and your keys are in your hand, you should not be buying something. And the reason I bring this up is because it's happened. So I've had a client literally go out and try to buy a new car on the day of closing. I had another client literally trying to put another offer on another house on the day of closing. All of those changes, all of that stuff definitely has to be done after the fact, after you end up getting your keys, after recording. You got to make sure that you're covering your bases and that you're not creating hiccups where you definitely don't want hiccups. Next on our don'ts is do not, let me repeat, do not change your employment. Changing your employment also includes do not retire from your employment. I had a client that did this. They retired from their employment. Now the retirement, they weren't even going to receive any of their income because they were actually given a severance to be able to not have to work anymore at their employment. This was back last year in 2020 when the pandemic happened. However, the hiccup was that because the actual retirement income wasn't going to start for at least 6 months because she was going to be living off the severance income. Severance income is not continuing income. You have to be able to have income that's going to continue for a minimum of 3 years to be able to show that you have income and stability and ability to pay the mortgage. The hiccup when you run into stuff like this is that Social Security, pension, stuff like that, you're going to have the ability of repaying because it's going to continue for a minimum of 3 years. Well, when you're living on the severance pay for those 3, 4, 5, 6 months, that's not going to continue for 6 months. And so that's one thing that you definitely got to know. You cannot change your income. You cannot change your employment from a regular job to retirement. Other piece of the employment though is that you definitely don't want to change your employment at all either. The thing that you got to remember is that depending on where you're working, depending on what you're getting paid, what you're hourly, or are you a commission, or do you get bonuses, all of that income may or may not be usable. Too many times I've ran into clients that go from one employment and then move to a different employment, and now the new income is not usable. Next on our list for don'ts of what you do not want to do during your home financing process here in San Diego is going to be not changing your employment. So in making sure that you advise us that you do change your employment in something that happens, you definitely just don't want to change your employment. This has created so many more hiccups than positives. You want to make sure that the way that you start your application is the way that you finish your application. And that means, like, for example, construction workers. So if you're a construction employee and you are currently with one employment, but you're with the union and you're changing your different employments, that's not going to really make a big deal. Why? Because your average of income is going to go based off the last 2 years. However, let's say that you were a construction employee and then you went to be a commission employee and now you're a sales rep. Well, those are two completely different fields, and now you're creating problems where you didn't have problems. Things like that you definitely got to be aware of. Changing your employment also goes back to the retirement aspect. You don't want to stop being employed, which will now create a problem, and now you won't have the same income. Maybe it'll work, maybe it won't. Do you really want to go down that route? Maybe going to cause you a problem whether you're going to be able or not be able to close and get your keys on time because you decided to change your employment during those specific 17 and 21 and 30 days. I would say not. So if you're going to change your employment, definitely do it after the fact. And if you're going to change your employment, you definitely want to give a heads up to your lender, because did you know that they're going to verify your employment all the way down to the end? So if you change your employment when you're at closing, it's not going to be, oh, they're not going to know about it. No, they are going to know about it because they're going to verify you still work there on the day of closing. You've got to make sure that your employment is set up right and that you don't have any hiccups when it comes to changing employments. In general, you shouldn't change employments. Next on our don'ts is do not co-sign for somebody's debt, meaning co-signing for somebody's student loan, car loan, personal loan, having somebody add you as an authorized signer, adding additional debt. We've already covered this piece. Obviously, it's going to create additional hiccups when it comes to your qualification. But you adding or allowing somebody to run your credit along with their credit to obtain new debt, it is as if it was your debt. So think about it this way. One of my clients just got not one, but 2 car payments. Why did he get 2 car payments? He already had a car. Well, he got it for one daughter and then he got it for the son. So each of them got a brand new car. Yes, they were twins. Problem is that if you add new car payments, and in his case, the kids were supposed to pay for them, but they're brand new car payments. So because they're brand new car payments, you don't have the history that shows the kids are making the payment, even if they are or are not on that car payment. So you've got to make sure that any cosign details are not happening during those 17, 21, 30-day process. I know it totally sounds like repetition, but I'm totally being serious. You got to make sure you don't cosign any debt. And that applies to even student loans. Too many times I hear that, oh, well, the student loans don't have payments. Technically speaking, student loans do have payments. Even if they're in deferment, there's only a couple loan programs will allow you to not include the debt. Most of the programs will actually require that you calculate a percentage based off of that student loan, even though there's no payment. And the problem with that is that depending on the loan program will depend on how high that calculation is. So you could obtain, let's say, a new student loan for your kid, and that student loan is $20,000. Well, what's $20,000 based at 1 to 5% of that amount? So when we start doing that calculation, you're looking at like 1%, about $200 at 1%, versus 5% on that same $20,000 balance for the student loan that technically is in deferment and doesn't have any payments. That's $1,000. That is definitely going to change your qualification. So on that note, you want to make sure that you are not co-signing for anybody, especially when you're in escrow. Next on our don'ts is do not assume you're going to get money back after closing, that you're asking the seller to give you an allowance or to give you a seller credit, and that you're going to end up getting that money. I just ran into a client that was actually going to give a credit to my new buyer. One of my clients from the past is actually going to sell their home to one of my new buyers. Cool as that can be, hiccup was that my current now seller, old client, is actually going to give a credit to the new buyer. Well, in giving the credit to the buyer, my buyer thought that he was going to end up with a $30,000 credit towards his closing costs, towards his after the fact home improvements, meaning that he was going to end up with $30,000 in his pocket to be able to make all of these home improvements. Unfortunately, the home that he was buying is not HGTV ready, therefore it does need some work. Then because it was being sold this way, the seller was willing to give them money. While this is not common in today's market, it was happening, and she was going to give him a credit for the overall closing costs. The one thing that they both didn't actually communicate together, though, was that the seller was actually going to give a reduction of a sales price, meaning that they were going to buy the house for a little bit less, as the buyer was going to buy it that way, and then the seller was going to receive less profit. Not necessarily that she was going to give him $20,000 or $30,000 towards their home improvements after the fact. So first off, there is actually limitations as to how much money the seller can help you with. And majority of the time, and I mean almost all of the time, the seller can help you anywhere between 3 to 6% towards your overall closing costs. However, again, back to this market, that's not going to be really common. They're not going to be giving you really kind of a seller credit to be able to help you pay for closing costs. Right now, there is so many buyers and so little sellers that the competitive aspect is definitely on the high right now, meaning that you're not going to end up getting those credits. If you're asking for credits, odds are that unfortunately your offer is getting passed up for somebody else that's either putting more money down or giving a large cash deposit or paying for the closing costs for the seller, or maybe just doing a cash offer. So things like that, you got to be able to be aware, especially in today's market and in general. So even if it wasn't right now like the seller's market that it is, or let's say last year in 2020 or 2019, you're still not going to end up getting that money from the seller to pay for home improvements after the fact. Those are completely different details with regards to home loans that can be done, but they're not the same type of loans when it comes to like a regular conventional, a regular FHA. They do have different restrictions, different guidelines, and different requirements, and totally different interest rates when it comes to comparing apples to apples as to what you're maybe thinking about when it comes to the details of your new home loan. All of which needs to be decided for in the very beginning. And on to our next don't is that you don't want to go through this process without us. You definitely want to reach out to us. Give us a call, send us a text, or an email. When you're thinking about making that move to somewhere in San Diego, Riverside County, Los Angeles, or anywhere in California, you definitely want to give us a call because we got your back. And if you have any questions, feel free to put some comments down below. Happy to reach back out to you, answer those questions. And don't forget, every single week we release videos on this channel about what it's like to eat, live, sleep, and play here in San Diego, and everything about the best home loans. And until next time, we'll see you later.